But let's shift focus and talk macros, because after all, markets are in a way a reflection, and there are a lot of data points on the macro side which market pays heed to. We have Dr. Samiran Chakraborty, Managing Director and Chief Economist of Citi Research, who's joining us now to talk about the macros. Dr. Chakraborty, thank you very much for your time. What kind of GDP picture, in your view, do you think we would be throwing up, especially in light of what's happening in the rest of the world?
Sure. So thank you for having me on your show. I guess the way we are looking at it is that for the April-June quarter GDP, the print could be about 8.3%. This is slightly ahead of the consensus view that is there on the street. And it would translate into probably about a 6.2% GDP growth for the full fiscal year 24. In terms of the qualitative nature of the first quarter GDP, we would expect a very strong double-digit growth for both manufacturing as well as the construction sectors. But we will somewhat caution that this number needs to be taken with a pinch of salt, because this is boosted by very favorable base effects. Without the base effects, the number tracking about that 6% for the full year is probably telling you about the right momentum in the economy.
So need to factor in the base effect when you look at that high GDP growth that you see in this quarter. But I just wanted to shift the focus, Samiran, and talk about inflation as well, because that was one of the key highlights in the last meeting of the MPC as well, wherein the revision happened on the inflation front. Do you see that ebbing at all with the spike that we had seen temporarily in tomato prices, etc., or do you think it's going to be a lot more stickier?
So I guess tomato prices have already started coming off quite materially, while we are slightly worried on the onion prices, which have inched up a bit. But still, our sense is that the August inflation trend should be below 7%. And after the yesterday's cut in LPG prices, the September print could be even below 6%. We expect that the LPG price cut itself will deliver about a 30-odd basis point of reduction in headline inflation. And if we don't see any further price shocks between now and end of September, then it should be good news in terms of inflation falling below 6. Having said that, the newest worry in some sense is about this extremely dry August that we have witnessed. It's too early to say how much of damage to crop yields this is contributing to, and to what extent even the winter crop will get impacted by this. But that remains the key risk. Without that, for the next couple of prints, inflation numbers could surprise on the downside.
Been a dry August, but I just wanted to shift focus back to what you were saying about the LPG subsidy that has come in yesterday. And we were just speaking with the minister himself, Mr. Hardeep Singh Puri, and he talked about how the fiscal situation is not at all a worry as of now. The balance sheet, as per him, still looks very healthy when it comes to the government's balance sheet. But that's the worry, right? With just the elections around the corner, the slew of subsidies, the slew of handouts might really continue. Do you see that as a worry at all?
So, well, it's difficult to forecast on exactly what all new subsidies would come in between now and the end of the year. But suffice to say that till now, whatever we have witnessed, the fiscal situation continues to be in control. In fact, even yesterday's LPG price cut, the government estimate is that this is only about 7,000 crores of extra money. We kind of agree, because part of the reduction in prices were anyway due because of global fall in prices of propane gas, etc. So to that extent, this particular move is not worrying from a fiscal slippage perspective. But as we know that we are on a tight balance, the revenue numbers and expenditure numbers for the first quarter were exactly in line with where the budget estimates were. So from that perspective, there is not much elbow room left to do additional expenditure. So my sense is that the government government, if it wants to do some additional spending this year itself, then some other kinds of expenditure will have to be curtailed, or else most of the populist measures will get announced in the FY25 budget rather than being implemented in FY24 itself.
Chakraborty, we saw a very clear change in stance by our own RBI governor this policy gone by, probably citing some of these risks and saying that we have all the options on the table should the situation arise. Probably sending a message to the entire ecosystem that one more rate hike perhaps could be warranted if things turn adverse, and it's a pause, not a pivot. Going forward, the way these macro issues are panning out, erratic rain related impact on vegetables, though they have come down, now unusually warmer August, how long do you think this situation could persist before any change in stance further from our own governor?
So our sense is that RBI will at least wait till in the October policy, given that the vegetable prices are on a decline now. October would be too early to react. December can become a live policy if some of the preconditions are being met, like the RBI will have to be seeing at least 2 quarters of average inflation exceeding 6%, the July-September quarter and the October-December quarter. It needs to find some signs of generalization of food prices into non-food items. So I think one of the markers for them would be that core inflation momentum should not cross 0.4% month over month. That would be one of the key red lines to look out for. And, any rate hike at this juncture will be not in line with how global central bankers are reacting. Most of them are almost on a retreat now from their rate hikes. So there has to be pretty solid reason for RBI to change tack after 10 months of pause to do a hike in December. So my sense is that given our current projections, a rate hike possibility is low. However, there is always the risk that RBI tightens liquidity even further and in some sense use that as a tool of managing inflation, not using the rate as much.
That's the word coming in. Thank you, Samiran, for joining us with that take on the economy and how the various factors are playing out.